Hi folks, welcome back to Murthy Finance Academy. Today we will be discussing one interesting player from the recycling space. The company is none other than POCL or Pondy Oxides and Chemicals. So before we start, a quick disclaimer: I'm not a SEBI registered analyst. Whatever the companies we're going to discuss are purely for educational purpose. Now let us start. So the Pondy Oxides and Chemicals has reached an inflection point in capital intensity, reporting a Q3 fiscal 2026 revenue surge of 54.5% year on year, a staggering PAT explosion of 216% year on year. The operational narrative is undergoing a violent pivot from a legacy-led smelter to a high alpha multi-metal urban miner processing lead, copper, aluminum, and plastics. The real question for the Dalal Street is one of execution. Can POCL scale its massive 123-acre Mundra expansion and diversify into the battery metal stack without diluting the return ratios that justified its recent re-rating? While the Target 2030 vision promises a structural metamorphosis, investors must weigh this aggressive roadmap against a historical 5-year sales CAGR of just 11%, suggesting a significant departure from the company's conservative past. So, in the Indian circular economy, the narrative is often dominated by massive scale of Vedanta or the organized efficiency of Gravita India. EOCL, however, has spent 3 decades quietly securing its position as a critical node in the global battery value chain. What began as a regional smelting operation in Pondicherry has evolved into a sophisticated 3-star export house with a prestigious AEO T3 certification. By expanding its footprint to 20 plus global export destinations, EOCL has transitioned from local processing to a global procurement powerhouse, positioning itself to capture the massive tailwinds generated by India's battery waste management rules. So, the company incorporated in 1995 in Tamil Nadu, EOCL is currently India's largest secondary lead manufacturer. The business model centers on upstream integration into the battery metal stack, curing scrap like spent lead acid batteries, copper waste, and aluminum, and converting them into high purity ingots and alloys for global OEMs. So the company is having a capacity of 204,000 metric tons per annum of finished lead and alloy capacity. So it spans 500 plus employees managing a grid of 200 plus global partners. So the moat is for this company is POCL's primary defensive barrier is its 3N7 LME registered lead brand status. As the first Indian brand to achieve this registration, POCL commands a distinct quality premium in international markets. For a global battery OEM, LME registration is the ultimate trust proxy. It allows PCL capture an estimated 20 to 40 per ton spread improvement over uncertified peers. This isn't just a plaque on the wall. It is a license to operate in the high margin export corridors where unorganized players simply cannot compete. So the core of the POCL thesis is the transition from a low multiple recycler to a high multiple specialty chemical and circular economy play. Its target 2030 is the management's blueprint for this compounding math. So in a volume growth, if it sustains 15% volume growth and product mix, aggressively pushing value added products to 60% plus of the portfolio, and its margins targeting steady state EBITDA margins of 8% plus and ROCE about 20%. So the market is largely valuing POCL on its historical 11% growth profile. They are missing the shift to a steady state urban miner where earnings are driven by predictable scrap to metal spreads rather than absolute LME volatility. As Mundra comes online, the capacity delta could trigger a significant re-rating towards specialty chemical multiples. So the dam for recycling in India is undergoing a policy-driven expansion. The battery waste management rules have created a formal supply chain where POCL sits at the center. The company procures 70% of its scrap internationally, hedging against domestic supply shocks while selling 73% of its lead products to global OEMs. However, the business is not without friction. High procurement competition and the volatility of LME linked spreads remains the primary headwinds. If you see its unit economics by segment, POCL's operational efficiency is best analyzed through its granular segment splits. Its lead, which is a core cash cow, has a 204,000 metric ton per capacity recycling and 140,000 plus metric tons per annum of scrap per annum. So its copper is around 6,000 MTPA capacity, 100% import procurement, and serves as cable and wire OEMs. Aluminum, 12,000 MTPA capacity, operations commenced at the Sri Perambudur facility targeting the auto sector. And plastics with 9,000 MTPA capacity via the POCL Future Tech Private Limited. And its procurement strategy, lead scrap is 70% imported, mitigating local price spikes. Copper sales mix also 61% domestic and 39% export, providing a currency hedge. And if you see a geographical split for plastics, 59% is import and 41% domestic procurement, ensuring supply diversity. So the company's lead export focus, 73% of lead sales are exported, emphasizing LME grade quality dominance. So POCL's TTM, trailing 12 months performance, is around 2,524 crores, indicating a massive breakout from its historical orbit. Its revenue TTM growth of 35% dwarfs the 5-year average of 11%, signaling that long gestation expansions are finally hitting the P&L. Its margins also, on a TTM basis, OPM has ticked up to 7%. Historically, it stays around 5%. The ceiling is the 70% import dependency, which currently stretches the working capital cycle. Coming to balance sheet, borrowings have plummeted from 94 crores in March 2024 to just 35 crores in September 2025. The company is almost debt-free as it prepares for Mundra capex. Coming to working capital, its 65-day conversion cycle for March 2025, while stable, this is lower than peers like Gravita, largely due to the lead times of a 70% import procurement model. And the 100% TTM profit growth of 119 crores is a high octane mix of volume and price, while the operational shift to copper or value added products adds fundamental floor. The current earnings are partially boosted by favorable LME spreads. Sustain this, POCL must prove it can hold the 8% OPM line even when the commodity cycle cools. So the company's MD Ashish Bansal is signaling a more aggressive stance on growth and diversification. So they have quoted target 2030 vision sustaining over 15% volume growth. So here the 123-acre Mundra land bank is the delta. It provides the physical runway to actually double volumes. And whether the company increasing the share of value added products to over 60%. So this is the margin expansion lever. Moving from generic ingots to specific alloys is what separates a smelter from a specialty chemical player. So regarding the current business verticals, diversification into lithium ion. So this is a long-term hedge against the decline of lead acid batteries. Management is future-proofing the urban miner thesis. So 30 plus years of consistent dividend payouts along with bonus issue. So here it shows the company's high capital discipline even during expansion. Management has prioritized returning capital to long-term shareholders. So promoter holding also dropped from 48.9% in March 2024 to 39.34% by December 2025. Crucially, this occurred concurrent with a 175 crores QIP and 132.5 crores preferential issue. While this explains the dilution of a 10% drop in promoter stake during a growth phase remains a yellow flag. Are insiders pairing stakes for liquidity, or is the market's enthusiasm outpacing their own internal valuation is to be judged. So the company's ROC, which stands at around nearly 16.9%, our current levels are far below the 2017 peak of 34%. However, the 2017 peak was a commodity price fluke. The current 16.9% is high quality ROCE driven by volume and product mix despite heavy current capital work in progress for Mundra. And coming to debtor days, it also remained tight at 23 to 24 days, indicating strong bargaining power with battery OEMs. So coming to valuation, in a bear case scenario, if OPM regresses to 5%, growth stalls at 10%, the company could be trading at around implied multiple of 15 times PE. And in a base case scenario, if OPM hits 8% target and 20% revenue CAGR, we can see a company implied multiple of nearly 27 times of the PE. And in a bull case scenario, if OPM hits 10% and Mundra scale and re-rating happens, we can see its PE re-rating to 40 times. So at 27 times, the stock is pricing in significant progress, but not yet perfection. The gap between its multiple and Jain Resources 42 times represents the execution premium POCL earns if it can operationalize Mundra without a margin mishap. So some key risks which I observed is promoter dilution. The 9.5% drop in promoter holding over 3 years is non-negligible. It suggests the founders are comfortable letting institutions take the wheel while the target 2030 risk is high. And procurement fragility. 70% import dependency for lead scrap makes the P&L a hostage to global freight rates and international hazardous waste export terms. And execution delta. The Mundra facility is a massive leap in scale. Any delay in its commissioning will suppress ROCE and leave the company with a bloated balance sheet. So, what are some key monitorables to be watched out for? Are OPM threshold, consistent prints at or above 8%, Mundra milestones, tracking the 123-acre development into live capacity, and third is value-added product mix, evidence of value-added products crossing 60% of sales, and fourth, promoter floor, any further stake sales below 39% would be a major red flag, and fifth, lithium-ion progress, concrete timelines for the new recycling vertical. So POCL is no longer a small town smelter. It is a high conviction bet on whether an Indian recycler can trade at the multiples of a global special chemical leader. The bull case rests on the urban mining transition and a clean balance sheet ready to absorb Mundra's growth. The bear case is anchored in the promoter's exit and the inherent thin margin trap of metal recycling. For now, the TTM data is doing the talking, but the promoter stake reduction remains the whisper that won't go away. So POCL is a show me story with a massive potential for re-rating. Hope you like this video. If you do like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.